Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, October 3rd, 2023. Welcome back to the podcast, George.
Hi, John. Great to be back.
Good to have you. And, we've got a ton to talk about. Today, for our readers' benefit, we're recording this, as I said, on Tuesday, October 3rd. Market is just absolutely getting smoked. Treasury yields are, 10 plus basis points higher, out the curve. Dollar yen breached 150. Stocks are getting shellacked. So plenty to talk about. Stepping back a little bit, George. Since the last time we spoke, the Treasury market has just been on, I guess, what I describe as the exact opposite of a tear. It really has felt like a one-way train to higher rates via a pretty significant bear steepening of the curve. Almost as interesting is that risk assets are, what I'd argue, finally taking notice with credit and mortgage spreads widening, stocks getting hit. What's your take on price action?
Yeah, no, so this has been a story that has continued to develop really since the middle of the summer. And, for our listeners and viewers and readers of all of our content, this has been largely our house view on the bear steepening side. Not really imagining that we would get to these sort of levels, so we don't want to pat ourselves in the back too much. But in general, this has been a real massive repricing of rates, normalizing and getting higher and higher. But it's really not driven solely by Fed action. And in tandem with this, risk markets also starting to kind of feel the pressure. It's resulting in a significant amount of financial conditions tightening. So we're really seeing something that's different. So we've had a move in throughout early August with a repricing of expectations around the fiscal side with more deficits and larger Treasury auctions, concerns about we had the Fitch downgrade. So we this has been a story that's been developing for weeks now. But then of course the more hawkish Fed in terms of their dots. But it was really more about just kind of like the biggest mispricing has always been the belly to the long-term sector of the curve. And that's why if you look at the way the 2 years moving, or even Fed expectations, they're barely budging. They're getting pulled up a little bit because there's so much pressure in the rates market, as you described today. But in general, this is not about Fed expectations. This is clearly a repricing of just a normalization of rates that have been decoupled from just overall Fed expectations, but also like maybe adding additional term premium. And that's really driving people to take notice. And we've also it's also the speed and the magnitude and breaking through some key levels, right? We like to think of things in like these incremental type moves, and at least in long-term rates like the 4%, the 4.25, 4.50. Now we've broken through 4.75 on the 10-year. It really does open up like what is the potential top. We don't know. Nobody really knows. We penciled in that 4 7/8, 5% should start to kind of get to really stretched levels, considering how fast the move has been, and the technicals are now nearing multiple decade oversold conditions. So at some point this thing will stop. But as I've been saying, both publicly and in written form, there's really no benefit in trying to catch a falling knife.
Yeah, certainly not. Better to let the knife fall, the piano bounce, however you want to say it. And interesting that you point out, that resonated with me. It's not about Fed expectations. The market's still pricing in about 50% of a chance of another hike. The market's still pricing in significant rate cuts. Into next year around 70 basis points, which I think is pretty similar, to where things shook out after the FOMC meeting, if I recall correctly. But let's move on. I think the backdrop that you just gave serves as a pretty natural shift to highlighting some of your thoughts from your latest Macro to Markets monthly, titled "Same as It Ever Was," an awesome nod to the Talking Heads classic "Once in a Lifetime." Why don't you take our listeners through the high points?
Yeah, no, I think just I'll focus on the macro and also the micro kind of conclusions to the piece, which is that we're experiencing this repricing of rates, also a pretty decent move in the dollar, which is another form of tightening. And up until recently, but we'll see where oil settles in the coming weeks. But we've also had a pretty big increase in oil prices throughout the summer and through the latter part of September. So we've had three large macro variables: oil, dollar, rates, out the curve, which matters more for the more interest rate sensitive sectors like housing and corporates. And we've had some pretty significant moves that you need to kind of take a step back and respect it. And for us, like this idea that rates don't matter or that Fed tightenings don't matter, which was kind of like on the fringe being suggested that we can handle higher rates. I still don't buy that theme of that argument, and that's why we kind of dubbed the piece "Same as It Ever Was," because we believe that eventually these long and variable lags of the overall totality of the hikes plus quantitative tightening and now this additional supply, the crowding out that it means for other fixed income markets, it starts to really take its toll. And I think we're in the midst of that. And we just don't know what that means and how it settles ultimately. But I do think that this is part and parcel for a tightening cycle, especially one that was so aggressive, but also happening after the massive liquidity injections. This has been an uneven and just not a normal recovery cycle to begin with since the start, that we should expect things to operate differently. But doesn't mean that it's completely different. And that's why, same as it ever was, we eventually, if you have all this volatility in markets, eventually it translates back into the macro. And you do have the chances of a soft landing keep going down in my book, and they've been very low for quite some time. And it just increases the odds that something breaks financially or in the economy or both. And that's been the mantra. So it's same as it ever was. It's going to end in the same way. And as we suggested on the macro side of the piece, at this point, if the Fed really was forward looking and they're taking this into account, I mean, they probably should start thinking about how to ease, but they're so focused and, of course, concerned about inflation, and that's what really holds them back, and rightly so. Then it's hard for them to ease. So, like, we're in this kind of place and time where we just have to let things just kind of work themselves out.
Yeah, you covered a lot there, but I just a lot of this resonates with me from doing this podcast, every week or so. But a lot of people, as you said, were saying rates don't matter. It's kind of sounds a lot like it's different this time, which is almost always wrong. Long and variable lags. You've been saying it's something Powell's, taken, I would say been very careful to repeat a number of different times. And then also the theme on a lot of these podcasts, as well as in your strategy pieces, is something higher rates will break some higher rates, higher dollar, something breaks at some point. So we've covered a ton of ground. So I really don't have another question for you, but I guess, is there anything we missed that we could, close out on?
Well, again, I mean, look, we're at the time of the year. We're in a new quarter. We averted a government shutdown, but there's, of course, still a temporary budget stopgap measure in place until the 17th of November. So there's still, potential for political drama out of DC, and there's concerns around that. So, and again, the macro backdrop of these higher rates really starting to kind of crimp the consumer heading into the critical shopping season of the end of the year, and the restart of the student loan payments. I mean, those things are the macro. They take time to filter through, but they're also impediments that could really result in a very weak fourth quarter and Q1 of next year. And then we might look back, or the NBR will look back, not us, and they might determine that this might have been the recession. We don't know, right? This is one of those things where you only know by going through it. But for us, the getting the data right, or understanding what the data is really telling us, and realizing that this is the time where, if we are truly at an inflection point, a lot of this data is going to get revised anyhow, and we're going to look back and say, hey, we were in a recession or some sort of really weak environment that we just couldn't tell. You can see that even from the benchmark revisions that we had from GDP last week. When they have these big reassessments, you realize that things were different. So I think we're in this this part in time where again, the tightening is going to matter. Watching how dollar operates, looking at just funding markets, liquidity. I think all those things are going to be what sets up for what kind of end of year we have. Critical levels on stock markets in terms of where they are technically, can they break to lower levels, and that would be another form of financial conditions tightening on the consumer. So I feel like it's this kind of, again, the culmination of what we kind of again described in the piece, that it's the same as it ever was, but also now we should be really laser focused on market liquidity, especially in the biggest one, like the Treasury market, and dollar liquidity and the availability of dollar funding. I think those are going to be what really matters, and I think that's going to then filter its way through to credit eventually, and stocks. So I think this is the moment, and I've said it a number of times before, but considering the speed of how rates have moved and what else is going on with the dollar, I think that we're gonna find out a lot about what actually is happening underneath the surface, and that will set the stage for these asset classes into Q4. And then the implications for the economy, and then we'll see. But the one thing, obviously, we don't want to end on a dour note. And the one thing is that, like, these sort of fast flare-ups eventually do burn out, and eventually you get to a better place. So I mean, the good news, at least for me, is that hopefully we'll figure this out sooner versus dragging it out.
Yeah, I like that, ending on a high note. But it sounds like very clearly what's been an incredibly eventful year in the markets will be to, I guess, just continue to be into the end of the year. So plenty of things to watch for. And to our listeners, I would encourage you to review George's recently published Macro to Markets Outlook, same as it ever was. And if you are not receiving George's strategy reports, please do get in contact with him directly. Great stuff as always, George.
Thanks, John.
Thank you. And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.